Good morning, ladies and gentlemen, and welcome to our tax chat. We can't believe that it's June already. I think next month is Christmas. We had our previous tax chat in February. We plan to have one every month, and as time flies by, before you know it, we are in June already. I am very pleased to introduce to you my co-presenter for today, who is Tosca dos Santos. And Tosca has been I've known Tosca for over 20 years. Tosca and I were joint partners at KPMG. I met her when she was still a newly qualified CA, and today she has got two qualified medical doctors as children. I think they saw a mother and they saw a father who was also a doctor, and they said it's easier to be a doctor than to be a tax advisor. So Tosca has got a wealth of experience. She's been a partner at KPMG with me for many years. She spearheaded the tax risk management side of it, so she knows everything to do with tax risk management, tax management solutions. She also headed up the quality control side of the tax side of KPMG, and knew about practice management across the world. She did quality control across the world. And then for the last 9 years or so, she was head of tax at Telkom. And I'm so pleased that she's joined us as a partner here as a director at Kreston. And our service offering has just increased significantly for our clients. So I'll do the first 30 minutes, and then Tosca will discuss with you some interesting recent case law. So unfortunately, you have to bear with me for the next 30 minutes, and thereafter you can have some fun sections with Tosca. So I was thinking about what to talk about today, and our national budget has not been approved yet. So it's been toing and froing, and we're sitting with the national government, and we don't know where the funds are going. And we've seen Ramaphosa and his whole team talking to Donald Trump, and the whole world has gone absolutely mad. And if we just and I thought about where we are sitting in South Africa, because everybody is saying, well, we need money and we need. But how are we going to get the money? And that's made me think about this so-called Laffer curve. So the Laffer curve says that the more you increase your tax rate, you've got a point where as you're increasing the tax rates, you're actually getting more money in. You're actually getting more tax revenues in. But at a point, as it moves too high, then your absolute tax revenues start decreasing. And that is kind of like when you look at the totality, they're saying it's around about 70%. Now, obviously, you've got to add up all the taxes. You've got to add your 45% personal taxes, your 50% provisional tax, your 15% VAT. You've got to add your ad valorem duties. You've got to add everything in there. Once you start looking at that, and what happens when your tax revenue is so high? So think about it in absolute terms. If the tax rate was 100%, then quite clearly everybody will just stop working, because as you work, you'll just take 100% and give it to SARS. So obviously, SARS will just not get any money. So the concept of the Laffer curve is, obviously, as a tax rate of 100%, the money that government will collect will be absolutely zero. So there is a sweet spot in it. What happens when you are going into that point there on the right-hand side beyond the Laffer curve? You've got reduced consumer spending. When it's discretionary spend, you just say, well, I'm not going to do it. You've got reduced incentives from employees to work harder, because if I work harder and I get a bonus and I get almost nothing out, why the hell should I work harder? So on a global scale, you've got reduced productivity. There's increased immigration of the wealthy. There's a reduced incentive for companies to open up businesses in South Africa. Why should we bother? And importantly, and this is really the topic of my discussion today, there's an increased attractiveness of tax evasions or elaborate tax avoidance schemes. It becomes worthwhile taking the risk, because if government is going to take all your money, then you play around with detection risk and not necessarily just on staying within your borders. And there's lower voluntary tax compliance, because what you have in a perfect world, if you think that the money that you pay is reasonable, it's being spent wisely and all that, then you comply voluntary. And from a SARS perspective, they don't have to spend so much money in order to make sure that you comply, because people will just comply automatically. So So then it increases the cost of the enforcement. And this is really, when you look at the budget speech that's been announced on the 21st of May, another 7.5 billion rand has been allocated to SARS in order to increase its capability to collect the taxes. So the voluntary spend is much less. Now, John F. Kennedy talked about this Laffer curve. Now, it'd be interesting if you knew that the highest marginal tax rate in America was around about from 1944 to about 1971. Now, I think that is the time of the Second World War, the Korean War, of the Vietnam War, of all of these wars. It was 94%. And John F. Kennedy said, no matter, you can't just by increasing the tax rate to 94% and let a person only keep 6% of his earnings, then you actually, you would actually earn more money by reducing the tax rates. Winston Churchill says is that if you want to try to tax a country into prosperity, it's like standing in a bucket and trying to lift yourself up by the handle. And that I do think it is, because you cannot tax yourself into prosperity. How do you create prosperity? Obviously through economic activity. And this is now in the context of this, and we've talked about that at earlier stages as well, in the Auditor General report, and that is just on the national and provincial level, talking about 400 billion rand of irregular expenditures over the past 5 years. Now, if you spend 220 million rand on a university, it's more or less going to cost you. You can build 2,000 universities with that money. So there's 400 billion rand that has been irregularly spent by national, that excludes municipalities, over the last 5 years. That is absolutely shocking. If you look at what happens at Eskom, Deloitte reports that, and this is in their report, they're not saying maybe, they're saying it is. They're saying resources of the public entity were not utilized economically as required by Section 57B of the PFMA. The non-compliance resulted in a reportable irregularity as reported in the report on other legal regulatory requirements. Similar non-compliance was reported in the prior year. So Deloitte are reporting to IRBA that Eskom there's a reportable irregularity. They're not spending the money economically. If you get to Transnet, then they have just been exempted from reporting on irregular and wasteful expenses. So it is so big that National Treasury said, don't even bother reporting on it, because otherwise we're just going to have qualified opinions. So if you want to create economic activity in a country, you've got to have a solid public infrastructure. You've got to have a solid electricity, reliable electricity. You've got a solid port structure, transportation structure. So Transnet and Eskom, neither of them are spending the money wisely. And then within this, do yourself a favor and click on the reports of the Zondo Commission on the state capture. And he says, how the hell did we end up with a president like this? And you can go and look at it. It's in his report. He said, how can you end up with somebody that will just fire public servants because they will not help him to get Guptas into the right positions? And then he is elaborating, and he's saying, maybe we should have a system, and he actually quotes it and says, maybe a system like the USA where people directly elect for a president. And he says, well, there's no guarantee that you may end up with a president like Donald Trump, but then you can only blame yourself. So, because obviously now our system is you blame for you vote for a party, and the party, which may be at their national Congress or whatever, there may be 500 to 600 people, and they vote the president, and you end up with a president that you may not even want. You may want the party, but you may not want the president. So I do think, but nothing's happened with this recommendation. I do think it's worthwhile, I think, because I also think that if the president is elected by the people, then they will not be so much involved with party politics. Pravin Gordhan, as far away as 2012, he said, growth in tax revenues thanks to steady improvement in compliance with African taxpayers. We should never take this commitment for granted. We spend taxpayer money wisely and receive the best value for money. And the current Minister of Finance, Enoch Ngubana, he also said, this is out of the budget speech of 21 May. Let me call on every South African to honor their tax obligations and contribute to building a better and more equitable nation. we thank them and we do not take this for granted. Yes, good, well said. As a government, we know that we must earn the taxpayers' trust every day by spending public money with care and ensuring that every rand collected is spent on the intended purpose. We recognize the urgent need to do more to achieve this goal. We are not deaf to the public's concern about wasteful and inefficient expenditure. It's not the public's concern. The Auditor General is saying that it is wasteful and inefficient expenditures. Our commitment to collect taxes must be matched by better efficiency in how the money is spent. Yes, obviously. It must be matched by stricter oversight. So what is in the budget? Are there any more controls? No, there is just an extra 7.5 billion rand that goes to SARS. So the one side, the minister is saying, yes, we acknowledge that there's wasteful and fruitless expenses. The Auditor General is telling us that there's 400 billion rand over the last 5 years. But that side, okay, hang on, yes, what's easier? What's easier? Let me give SARS another 7.5 billion rand. And SARS is saying, don't worry, if you give me 7.5 billion, I'm going to give you a return on investment. We're going to use that and collect 20 to 50 billion rand more. And more importantly, we're going to more and more use technology in order to find these people that do not pay their taxes. I do agree in a strong SARS. It is very, very important that you've got a strong, well-equipped SARS, but there is a balancing act. You cannot compensate for for wasteful expenses by just increasing your compliance. And as you can see, we're in that Laffer curve. So you've got the tax rate that's so high, and then you have to bolster your SARS in order to collect that money. All right. So I thought in this, us as tax practitioners, as accountants, and as businesses, we're kind of like in that realm because like never before, we've got the one side, the perception that government is just wasting money. So you've got a low tax morality. The other side, you've got an extremely strong SARS, an extremely strong legislative framework. And all these slides will be distributed. So if you do have a few moments available, please read through these slides because I'm not going to go through them. I'm just going to highlight to you what happens. Firstly, it's important to know what's the difference between tax avoidance and tax evasion. So, yeah, you must pay your taxes, but you don't have to leave a tip. And then Goldwater says the Income Tax Act created more criminals than any other single act of government, which is, I suppose, also true. So this is just a summary of it. When you have an arrangement and there's a tax benefit, you have to be able to put it in the right block. So whenever there's tax benefit, you look at it and say, oh, I've saved tax. Oh, I've got some money. You have to put in the block. Am I busy with tax evasion? Tax evasion, bad. Tax evasion, it's chuki time. So tax evasion is bad. Tax avoidance is okay, but in tax avoidance, you can see there's subcategories in tax avoidance. Now, tax avoidance, there are elements that says tax avoidance is something that's legal, but by law, statutorily, it's impermissible. So that is generally when there's round tripping of finance, when there's no business outcome, when your tax is not driven by business, but your business is driven by tax. It's as simple as that. That's governed by sections 80A to 80L of the Income Tax Act, section 73 of the VAT Act. And then under tax avoidance, you've got the permissible point. Now, this is where you can play. That is where you can do it. But under that one, you've got a potential reporting obligation. So you've got a reportable arrangements under that one. So, so what's just some simple examples. If you keep an accurate logbook, that is tax avoidance. But if you crook your logbook, that's tax evasion. If you use an assessed loss legitimately for business reasons because you want to resuscitate the company, that is totally legal. But if you falsely disclose income into a company that's got assessed losses, you're just shifting profits around, then that is tax evasion. If you employ people in order to qualify for the employment tax incentive, that is fine. That's obviously a government grant, but let's call it that is legitimately using an opportunity. But if you're disguising a bursary to be a employment contract, that is tax evasion. Okay. Now, there's legislation directed towards curbing tax evasion, which is the bad thing. That's the bad one. That's the one you're not allowed to do. Now, you can look there through the Tax Administration Act in section 234. Now, this is any person who willfully, so you do that on purpose, do stuff in order so that not even you, but somebody else. So if you're an accountant and you willfully make a false declaration, then you can go to jail for 2 years. This is willfully or negligently disclose material facts which should have been disclosed. So if you are an employer and negligently you don't disclose an item of income on an IRP5, then you can go to jail for 2 years. So this is willfully or negligently. Negligently is what is expected of a reasonable person with your similar experience. So head of payroll that's running a payroll should understand that if you give somebody a company car, it should appear on the RP5. So that could be negligent if you do not put it on there. So you don't have to get the benefit yourself. You can go to jail for something that is actually benefiting something else. So 2342 is quite an important one because it adds it to be the negligent side of it. All right. So this is evasion of tax of obtaining undue refunds, fraud, or theft. So a person with intent assists somebody else. So if you're helping somebody in order to evade tax or to obtain an undue refund, again, you can go to jail for 5 years. So the problem with all of this is that the accountants are sitting often in the middle of this, and you've got a government that's not spending the money wisely. You've got the person who's going to pay the money out of it. And he said, but hang on, can't we do something? Can't we do something? What can I do? Can't I, I've received this income, but I'm not declaring. Finish the clock, I'm not declaring. Then you've got to understand that you, even as a simple accountant, just recording that document, or the financial manager, you don't even have to be the financial manager. You can just be the financial accountant. You will take the risk of going to jail if you know about it. So the law is extremely, extremely strong. And this one, Section 180 for me is the very important one. So if you control or you're regularly involved in the overall financial affairs of the taxpayer, and because of your negligence or fraud, then the taxes are not being paid, then you can be held personally liable for those taxes. So it's not just limited to somebody that helps it. It's just limited to somebody that's regularly involved with the finances of the company. So you help the finance, and this company is trading recklessly under insolvent conditions, and you end up not paying tax to SARS. You can be held personally liability. The shareholders can be held liable for debt. The transferee can be held liable for debt. And this one, I'll do an example just now. If a person knowingly assists another person in dissipating the taxpayer's assets so that obstructs the collection of taxes, then you'll be personally liable for tax. So this Section 183 can be very, very wide. A few examples of this. About a year ago, you would see that there was a big issue about SARS versus Sasfin Bank. And what happened is SARS has conducted a thorough investigation into various South African taxpayers who had not made true and accurate tax disclosures to it. The investigation revealed that the taxpayers had colluded to expatriate funds offshore in a manner that obscured tracing the expatriated payments and jeopardizes the recovery of tax in South Africa. Sasfin made a SENS announcement, and this is what they said. Former foreign exchange clients of the bank, so they fired the clients, operated as a syndicate that ran an unlawful scheme to facilitate the expatriation of money out of South Africa and colluded with former employees of the bank. So they fired the employees, they fired the clients, but they operated outside the scope of employment. The details therefore disclosed in the integrated report, and the bank took decisive actions. But yet the bank is still being held liable for 4.8 billion rand, because as an employer, you're liable for the actions of your employees. So the banks are under huge scrutiny nowadays because they manage money on behalf of clients. And then often you say, why is the bank asking all these questions? They have to ask those questions because if they are negligently, or the employees are negligently assisting them to dissipate the assets so the taxes are not collected, then the bank can be liable. And then the ever-present Section 223 of the Tax Administration Act with all your understatement penalties that is payable. All right. Impermissible. So tax evasion bad, don't go there. Impermissible, also bad, don't go there. Now, it is quite complex legislation because it talks about circular funds and all of those kind of things. But generally, it is when you do a transaction and it's not done for bona fide business purposes. Now, the way at Kreston that we do tax advisory services, we say business first, tax second. You run your business. You say, this is where I want to go. And the starting point of any transaction is you want to run a successful business. And then we will assist you in order to make that as tax efficient as possible. So you don't start the other side. Don't start saying, listen, there's a scheme, and if I circular funds, I can actually get 45% back from source without it costing me anything. So the moment that you do something for tax and not for business, you are running the risk of impermissible avoidance scheme. Okay. And that is in the VAT Act as well as the income tax. Reportable arrangements is that many transactions, see, like if you do a share subscription and then you utilize the process to do a share buyback, then you've got to report that arrangement. If you buy a company, so if it's over 10 million rand, if you buy a company with a big assessed loss, you've got to report it to SARS. And if you don't report it, you can get a penalty up to R1 million. So the promoter or the participant must report it. So you've got to go and look, even if you say, oh, it's totally legal, because a share subscription and a buyback is absolutely legal. You can do that. Obviously, you've got to look after paragraph 43A and all of those kind of things. But SARS wants the opportunity to see whether they are comfortable with the transaction or not. So be aware of that. So what is ethical tax planning? That's the permissible. That's where we play. That's in the permissible space, even if it's reportable or not. Tax planning always follows good commercial practice and not the other way around. There's a difference between a tax uncertain position and tax illegal position. You can never take a tax illegal position, never, because you'll lose your qualifications, you lose your tax practitioner status as quickly. It doesn't create a reputational risk for the taxpayer. So I always sit back and I say, when you look at it logically, does this make logical sense for us? It's based on the sovereignty of the law. We are all loyal South African citizens. We love this country. The moment that we go outside the law, whether it's a tax act or a traffic law, whatever, we've got anarchy. We can never have anarchy in the country. It never rests on non-disclosure of material facts. SARS can have everything that I know, because within that framework, I'm happy to disclose every single. You never rely on a transaction that says, well, I hope SARS doesn't pick it up. And this is very important. Your planning must be based on the realistic expectation that SARS is highly knowledgeable of the law and that they will not rest until it's collected. I'll give you examples of that as well. For many people that are dialing in, they are head of taxes at companies, they are financial accountants, and often people have got a misconception about what tax planning is, because they think tax planning is just about sitting out there and thinking out elaborate tax schemes and saving some money from employees. It's not. Tax planning has got 4 elements. The one is compliance, and this is a critical aspect of your tax planning. Make sure that your compliance status is correct, but not just that it's up to date. That's actually correct. That once you submit a return, it is correct, because you can be faced with understatement penalties and everything if you submit incorrect terms. So compliance is part of your tax planning. The second one is tax certainty. Often what happens is companies will do transactions. They'll do share buybacks, they'll do BE deals, they'll do mergers and acquisitions, and then afterwards they say to the tax department, quickly have a look at this. No, you've got to have tax certainty before you do the transaction. Before you do the transaction, say, okay, what are the consequences of the tax? And let the tax team be part of that deliberations on what you are doing. It's about making sure that there's no surprises. It's about avoiding risks. You can very easily find yourself, you have a preference share that you issue with a major bank, and your preference share has got to be settled. The dividends got to be paid every 6 months, and every 6 months you've got to redeem some of the preference shares. If the board of directors doesn't actively say that the redemption of the preference shares will come out of contributed tax capital, then you've got a dividend tax problem, because now you have not made the election, you've not made the declaration to SARS, and without you knowing, if purely from a compliance perspective, you now do not have the right documentary paperwork. I spoke yesterday to a client where they disclosed a dividend payment to a local company shareholder 5 years ago. Can't find the declaration from the recipient that they're exempt from dividend tax. So you've got to avoid those kind of risks. And then obviously you've got to make use of opportunities and say, what is better for me? If I sell it outright, I'm going to pay capital gains tax it on. If I do a share subscription with a buyback, I've got a 15% benefit. If I apply 43A, if I don't have a qualifying interest, I've got a whole benefit. So you can use those opportunities as well. I'm going to close down in the last 5 minutes with with quite a relevant example. And this is an example of what tax planning is not. And it is quite ironic that this thing actually ended up in the Supreme Court of Appeal, because you're talking about one of the most wealthy people in the country. So obviously he's got access to brilliant tax advice. So obviously I've got no involvement with any of the defendants in this case. So all that I know is what I can see in the appeal court case. So let us go through the sequence of events. So this is the case of Kreston et al. And it's important that it's not only Kreston that was challenged, but also his advisors. And this is quite important from tax practitioners' perspective, because SARS uses this case as an example to say, listen, it's not only the person that gets a benefit, it's also the people who advise them who are at risk. So this was done on 12 July 2024, and this was in terms of Section 183 of the Tax Administration Act, where the defendants were challenged for 216 million rand. Now, and that Section 183, as you remember, it is where you assist another person to dissipate their assets so that SARS can't collect the tax. So let's just think about the sequence of events. Now, this is quite important as you go through the sequence of events. 25 January 2007, Energy Africa sold its shares in Energy Africa Holdings to a connected party overseas, not at market value. Now, a first-year student at a university will immediately tell you, if you're going to sell an asset to connected non-resident company, there's got to be something, there's got to be something. There's got to be either capital gains tax, there's got to be dividend tax at that time, there's got to be security transfer, STC. So what happened? So that just happened. We don't know where the deliberations, there's no tax opinion was given to the court, nothing that says, listen, it's not taxable or whatever. 5 years later, SARS issued a finding and say, we're going to tax you about 453 million rand. So now this is quite important. So November 2012, that's 5 years after the time, SARS says, listen, we're going to tax you. Then in April, so that's now 5 months later, they disputed the SARS finding. But 4 days later, and this is the key issue, Energy Africa transferred its only asset, being a loan account claim held in Titan share dealers, as a dividend in specie to Eland Spot Investments, its holding company. So what happened, Energy Africa was it's now subject. It had a letter of finding saying, listen, we believe you owe us 453 million rand. And they disputed it. 15 April, so they prepared a document saying we disputed. But 4 days later, the dividend stripped the company. 4 days later. Then in August of that same year, they issued an additional assessment for 453 million, and they raised 150% understatement penalty, which is intentional tax evasion. So they partially objected, but then they say, well, we don't have any cash, we cannot pay. So SARS reduced the assessment slightly, and they reduced the penalty to 100%, which is still gross negligence. So gross negligence is, for example, where you overtake a car on a blind height, so you can't see the opposite car. So that's gross negligence. So they will not appeal the assessments, and then they are liquidated in court. So, but now what's happened? Now SARS want their money, they can't get their money, but the only asset was distributed as a dividend in specie to Eland Spot. What they then did, they didn't go after Eland Spot. SARS went after Mr. Visser and Visagie and all the other advisors and say, well, you guys, you knew what was going on. You knew that there was something going on. You knew that there was a tax liability, and you still declared that dividend as asset in specie up to Eland Spot. So they held them personally liable for that. And they lost the case in the Supreme Court of Appeal. Now, this shows you the extent to which SARS will go in order to collect the tax. So often it happens, oh, I know that there's something going on in the company. Let's just close the company down, then SARS got nothing. They can go after the person who makes the decision to close down that company. So you should never underestimate the lengths to which SARS will go in order to collect the taxes and their desire to get money from you. Now, in this case, I do think This is not a case of tax planning. This is a case of an absence of tax planning. Back when in 2007, now remember this is 2024. So from 2007 to 2004, that's 17 years later, this thing came back to bite them. 17 years later, it came back to bite them. In 2007, oh, clever plan. Let's transfer our assets across at no value. We don't pay the capital gains tax. Let's hope that the assessments will just lapse in a time, and there's prescription and all of these kind of things. But 17 years later, it came back and it hit the individuals concerned. So be warned, this is a very important case to be out about the absence of tax planning. Tax planning is back at 2007. A reputable tax advisor should have said to Mr. Visa, listen, this thing's not going to work. Now, even that is before the Tax Administration Act. It's even before, which only came in 2011. But somebody should advise them and say, listen, guys, this is not a good idea. You cannot transfer it. You've got the tax liability, pay your capital gains tax, pay your STC. You can maybe get, a debate with SARS going about what the value should be, but you can't just walk away from your responsibilities on that. The last thing I want to quickly touch on is that also us as professionals, as tax practitioners, as CAs, as registered accountants, we all belong to governing bodies, and all of these governing bodies have got some kind of non-compliance with laws and regulations. What this effectively do is that if you do work for a client, more importantly, if you are an employer, and you see that there is a contravention of a law that can damage, that's contrary to the public benefit. So there's a materiality to it, which is not necessarily material to an ESCOM or whatever. It's a materiality. It's just a lot of money. That's just it. Then you have to do something about it. And generally, you have to report it to the person in charge of governance. They have to then respond to it. And if they do not do it adequately, you've got to take appropriate actions. You are then not bound by secrecy provisions. You can report it to SARS, you can report it to the Hawks, you can report it to the police, you can report it to the health and safety. It's not limited to financial. It could be that if you're sitting in a building and somebody is washing the windows, but they're not properly secured, they can fall off, they can kill themselves, they can kill somebody down below. So think about your no-clause, look at what the actions are. I've put in some 4 steps for that, what you need to do. But it is making it very important for us as professionals to be acting professionally in both as employer-employee relationship as well as towards our clients. So, yeah, today it takes more brains and effort to make out an income tax return than it is to make the income. So I'm going to hand over to Tosca now. I'm going to switch off the camera for a moment while we switch seats. Thank you for your attention. And I'm on my way to Durban, so we'll chat again next month. Thank you.
Morning, everyone, and thank you, Johan, for the kind words and introductions. As Johan mentioned, I'm going to be discussing a tax court judgment today that was handed down on the 2nd of December last year, so quite a recent court case. And in essence, this court case was between the appellants was Dr. X. Is a neurologist, as well as his incorporated medical practice, Dr. X Inc. He was the sole shareholder in this practice, and he was also the public officer. And obviously the respondent in this case was the Commissioner for SARS. So in essence, the dispute was that SARS issued the taxpayers with estimated assessments, and the taxpayers objected to this. If we have a look at the summary of what the assessments comprised of, Dr. X had an personal income tax liability of 26 million, penalties of about 51 million, a total liability therefore of 77 million. He also had a donations tax liability of approximately 177,000. We're not given a breakdown in the judgment as to what is penalties on that one. And then for that, Dr. X Inc., the incorporated entity, was assessed for undeclared output tax of 3.2 million and penalties of 6.5 million on that. So SARS then twice treated the objections filed by the taxpayer in respect of these estimated assessments as invalid. And what this court case was about was really the tax court, the taxpayer applying to the tax court for the tax court to issue them with an order that the objections were in fact valid. They claimed that SARS actually mixed up or confused the validity of an objection with the merits of the objection. But the tax court order found in favor of SARS, and it also ordered that the taxpayers pay SARS costs, including the cost of true counsel. And the impact of this is that those assessments issued by SARS remain unchallenged. It's quite an expensive lesson for these taxpayers to learn. So firstly, what is interesting is these were estimated assessments. We're going to look at how did we land up here. Secondly, the magnitude of the penalties. You can see they're close to 200%. Definitely in the VAT case, income tax almost 200%. And then secondly, that we found ourselves in tax court objecting, requesting a ruling on the validity of the objections as opposed to the merits of the actual assessments. So let's just remind ourselves in terms of what the taxpayers' rights are. So the taxpayers have obviously got a right to object to assessments raised by SARS. And this is governed in terms of the Tax Administration Act and also in terms of the rules which are promulgated under Section 103 of that Act. Section 104 allows the taxpayer to object to assessments raised by SARS that they feel they are aggrieved by. And then Rule 7.2 specifies the requirements for a valid objection. And in terms of Rule 7.2b, the grounds for objection must include the following detail. It must specify the amount, or well, the specific amount to which the taxpayer is objecting to. It must specify the grounds of the assessment that are the grounds in terms of which the assessment is being disputed. And thirdly, it must submit the documents required to substantiate those grounds. And usually these are would be documents that the taxpayer would not previously have submitted to SARS. And it's important to note that there's a distinct difference between an objection that is denied by SARS and an objection that is found to be invalid. And the remedies available to the taxpayer are therefore also quite different. So an invalid objection, in terms of Rule 7.4, SARS is able to invalidate an objection that doesn't comply. And this is a discretionary power given to SARS. And what the process should be is that in terms of Rule 7, the taxpayer will be notified within 20 days of submitting their objection that it's not valid. They then have 20 days within which to resubmit an objection to SARS without making any further application. But if they fail to do so within that 20-day period, they may have to apply to SARS for an extension to submit revised objections. And in situations where taxpayers feel that they've got a valid objection, that they're providing SARS with everything that it needs and requires, but SARS views the assessment as invalid, the remedy available to them is in terms of Rule 52.2b, whereby they can apply to the tax court for an order declaring the objection valid, which is the case that we were looking at here. just for the sake of completeness, before I go to that, the taxpayers in this situation did in fact, and we'll see this when we go through the timelines, they did in fact submit a second objection, but that second objection, as I mentioned, was also found to be invalid. Now, for the sake of completeness, we'll look quickly at what a valid objection is. So SARS can only disallow an objection that is valid. So if an objection is invalid, it falls completely outside of that process. And taxpayers can appeal against SARS's decision to disallow an objection in whole or in part, whereas a taxpayer can't appeal to SARS in respect of their finding that an objection is invalid. And again, in terms of the rules, one follows here, the appeal must be specific. It's very much the same as what we're seeing with objections. The grounds for disputing the disallowance of the objection must be specified, and any new grounds must be provided in terms of which the taxpayer is applying to SARS. So let's have a look at what led to these invalidated objections. So the reasons provided by SARS include, amongst others, the taxpayers did not provide the required documentation to substantiate the grounds of the assessment, the grounds of the objection, sorry. And they also didn't provide sufficient evidence to prove, for example, when it came to the personal income tax of Dr. X, to prove when the services were rendered, etc. And the grounds for objection that they submitted seemed to contradict each other and were also misleading. The taxpayers argued that the objections were valid and met the requirements, and that SARS was, again, as we said, confusing the validity and the merits of the objection. And when we have a look at the timelines again, we'll have a look at a bit more detail in terms of why these objections were invalidated. But in essence, the court found that, the taxpayer willingly and intentionally failed to provide SARS with the information that it required in order for it to actually make a final assessment. And therefore, SARS was put in the position that it had incomplete information and it therefore needed to go the route of the estimated assessments. In addition, the taxpayers were obstructive and they showed no cooperation and didn't show any indication of sharing the information requested by SARS with them. When they objected, they didn't actually object to specific amounts. The objections were actually quite general in many cases, without referring to any specific items and without providing the necessary supporting documentation to substantiate what they were claiming. Okay, let's move on and have a look at what led to the estimated assessment. So again, we traveled a long road with these taxpayers, and SARS issued multiple requests to the taxpayers. The audit actually started on the 30th of April 2021, and on the 7th of February 2022 were the finalization audit letters issued to the taxpayer. And thereafter, we've got another period up to the 22nd of September 2023, when SARS actually then declares the second objections filed by the taxpayers invalid. And throughout that period, the taxpayers were obstructive. They refused to provide SARS with the required documentation, and specifically in relation to their electronic system, which was the Health Bridge system, they refused to grant SARS access to that. So SARS throughout this period continued to warn the taxpayer that they were in possession of their bank statements, and in the absence of the taxpayer providing them with the information, they would issue estimated assessments. They pointed out that non-compliance with SARS's requests and with the documentary requirements could lead to criminal offences. They also raised on numerous occasions the fact that they could impose penalties, and specifically the understatement penalties. And they also gave the taxpayer a chance to remedy their behaviour by saying they would consider, if the taxpayer cooperated with SARS and gave them access to the health bridge system, this would be a factor that they would consider in determining the quantum of the penalties. SARS, as I mentioned, was in possession of the taxpayers' bank statements. They were in possession of their financial statements, and they were also at that point in time in possession of the zero accounting system records, which were maintained by the taxpayer's accountant. But what is interesting here is that SARS was of the view that they could not rely on the financial information or the other accounting records because, firstly, they noted that Dr. X Inc. was not subject to an external audit, and the statement by the accountants that since this is not an assurance engagement, that they were not required to verify the accuracy or completeness of the information provided to them by Dr. X Inc. So on that basis, SARS said, we can't rely on this. You haven't given us access to the health bridge system, which was the main system on which the taxpayer operated, just providing summaries thereof to the accountants for them to prepare the financial statements. So SARS went with the bank accounts in its possession, and it's also notable that those bank accounts were actually not provided by the taxpayer in all cases. SARS actually obtained those at times from other sources in terms of Section 46 of the Tax Admin Act, as well as they were also in possession of the taxpayers' investment brokerage investment accounts. So at the end, the estimated assessments were raised based on the bank statements as well as the broker's statements, and then other third-party information like where the taxpayer, Dr. X, was in receipt of distributions from a REIT, foreign dividends, etc. And they looked to that external supporting evidence in terms of making the assessment. SARS did impose understatement penalties, in most cases of 200%, and it really cited inadequate record keeping and obstruction by the taxpayer as some of the reasons for doing that. The court pointed out that the taxpayers were obliged to cooperate with SARS as opposed to being obstructive. The court found that while it wasn't an actual finding documented, they didn't even address the matter of whether or not the USPs of 200% were valid. And that's really because there is so much evidence supporting SARS imposing those penalties that it was a non-starter. And while the main focus and, in essence, what the judgment addressed was the validity of the objections in terms of Rule 7.2b, in the interest of fairness, the court looked at some of the other main objections raised by the taxpayer. And with regard to those, the court said that it addressed each one, and it felt that in each case, the amounts that were raised in the assessments and based on the information available to SARS was valid because the taxpayer failed to provide them with anything else. And it also found that those objections, other objections raised by the SARS, despite not being formally part of this application, were actually not valid in any of the circumstances. So I'm not going to go through this in too much detail, but I have set out for you, and you'll get a copy of the slides, basic summary of events. So firstly, this started with an audit of Dr. X himself. It was an income tax audit, and it was a capital gains tax audit for the 2016, 2017, and 2019 tax years. So already for me, just briefly, there's a 2016, 2017, this is 2021. Are we looking at prescription here, yes or no? SARS requested information within 21 days. The taxpayer does not seem to have provided the information. It was provided with details of the bank accounts and investment accounts, and the taxpayers were then actually, SARS then obtained the bank statements without the cooperation of the taxpayers. Then SARS extended the audit, having looked at the bank statements, SARS extended the audit to Dr. X Inc., the incorporated medical practice, in July 2021. And the scope of that was a VAT audit from the period April 2016 to February 2020, and a corporate income tax audit for 2019 and 2020. So there were numerous dates set out. It was also at that point in time already explained to the taxpayer that SARS would want access to the electronic accounting records, and if the taxpayer failed to provide the information, SARS was entitled to raise estimated assessments. This continued on. SARS was informed on the 10th of August, which was the date the information was meant to be submitted, that the accountants did not have access to the health bridge system because the taxpayer had two systems. It had the Zero system and the health bridge system, and that the health bridge system, in essence, had the bank accounts, had the debtors, kept track of all the services provided to patients, etc. On the 16th of August, the accountants were informed in writing that they needed to provide the information to SARS. The VAT audit was extended for March and April 2020, and that SARS wanted that information in a relatively short period of time, 20th of August and 27th of August. None of these deadlines were met. So we basically move through this, and it outlines, in essence, really, SARS then further extends the audit, the income tax audit for Dr. X Inc. Numerous things go unaddressed. There's a lot of communication between that period of time and SARS issuing its audit findings on the 27th of October, and that was to Dr. X Inc. So this was in essence, the VAT audit finding, but part of the audit findings was that significant amounts in excess of 26 million was paid to Dr. X by Dr. X Inc. And Dr. X had not declared this in his tax return, and that these amounts were in fact remuneration and either should have been subject to PAYE in Dr. X Inc. or should have been included in Dr. X's personal income tax returns, which they weren't. Then on the 2nd of November, that was on the income tax side. On the 2nd of November, they issued them then with the VAT audit findings, stating that in essence, they were raising a VAT assessment for the understatement of output tax. And SARS was of the view that there was a significant underpayment of output tax of about 3.3 million as a result of deposits of about 25 million that had been set off against other deposits, and as such, no output tax was accounted for these. And in this situation, SARS already raised the 200% penalty because it felt that there was intentional tax evasion by the taxpayer. And then in February, Dr. X was issued with his personal income tax assessment, and it was found that he had significant amounts undeclared. It was also found that SARS was of the view that prescription would not apply to the 2016 and 2017 years of assessment, because SARS was of the view that the amounts were not declared to SARS, and this was basically due to fraud, misrepresentation, and non-disclosure of material facts. So prescription wouldn't apply. They also found that there were donations made to the taxpayer's son, and that these should have been subject to donations tax. Okay. And then on the 7th of March was the first response issued by Dr. X, which we refer to as the, just in terms of those audit findings. But then on the 25th of March, SARS issued its audit finalization letter, and what followed was the assessments that we spoke about at the beginning. So the taxpayers then appointed a new advisor to represent them, and this new advisor then requested reasons for the assessments, and SARS provided those reasons. They then filed their first objection on the 25th of October, and on the 29th of November, SARS ruled that the objection was invalid. They then already, in December 2022, applied to the tax court to have the objection declared valid, but they even got a tax court date, etc. It was going to be heard in August, but both taxpayers actually then withdrew the matter. The taxpayers then submitted a second objection on the 14th of August, following their discussions with SARS. But the second objection that was submitted to SARS didn't really have significantly different things in it from the first objection. It did have a 17-page cover letter, and it did have over 800 pages of annexures. But these annexures actually didn't really address the specifics that the taxpayer was objecting to. And as such, these objections were again declared invalid. And it was in these objections that they raised the matter of prescription. And then in terms of the second objection, we see a lot of movement around that, a lot between SARS and the taxpayer in terms of trying to actually reach a point where the taxpayer provides SARS access to the health bridge system and provides them with the documentation that they're looking at, and we just actually never get there. The taxpayer is given numerous opportunities. You can't actually make up the sequence of events of this tax court case. It's really mind-boggling. But basically where we ended up is that on the 22nd of September, SARS said, the time is up. We are now ruling the objections invalid, and hence the taxpayer applied to the tax court on the 24th of October, and the judgment of which was passed down then in December. So in essence, the objections were from 30th of April to the 24th of October. The judgment was handed down, the audit and the objections, the judgment was handed down on the 2nd of December 2024. So it took approximately 3 years and 11 months to put this matter to bed. So very briefly, I'm going to go into some of the main lessons that we can learn from this court case. Firstly, foremostly, cooperate during SARS audit. SARS has got protocols for audits. They've got a requirement for direct access to electronic records, and taxpayers must grant SARS access to those records upon request, and non-cooperation with SARS can lead to adverse inferences and assessments, as we saw in this particular case. The importance of record keeping, it's really critical that you have full and proper records for 5 years from an income tax perspective in terms of the Tax Admin Act. The estimated assessments were issued by SARS really because the taxpayer didn't cooperate and they had incomplete records, and therefore SARS had to rely on the information available to it. understatement penalties can be costly. This is a huge number. I mean, of the assessment of 87 million, at least 57 million of that related to penalties. So again, they imposed those penalties due to gross negligence, etc., on the part of the taxpayer. And if this had been handled correctly, the taxpayer actually would have reduced the assessments, reduced the interest payable, etc. Dispute procedure matters. You cannot go into an audit situation with SARS and think you're just going to wing it. You're just going to write verbose explanations without providing supporting evidence to SARS. You are not going to take cognizance of the provisions of the Income Tax Act or the rules governing the dispute resolution process. And that's why these disputes are not, like particularly this dispute, it was not about whether or not these assessments raised by SARS were correct or not. We never got to really the merits of those assessments, but it was about the procedure that was followed. And they really lost an opportunity here, especially at the end with the second objection, when SARS disallowed that, invalidated that, apologies. When SARS invalidated that, they actually, at that point in time, still offered an olive branch and said they're willing to discuss, sit around it with the taxpayer to discuss how they can actually submit valid objections and what SARS is looking for. And this just never happened between the parties. They couldn't agree on a date, etc. So at the end of the day, these objections were invalidated. And these assessments remain unchallenged. So if they had filed those objections, the assessments would have been significantly reduced. They might have even been able to go to ADR. Tax law is complex, so we really do recommend that you get assistance from a registered tax practitioner. If you are aware of any amounts that have been undeclared to SARS in past periods, it's important to consider the voluntary disclosure program, the VDP, and this was really also potentially a missed opportunity if Dr. X or Dr. X Inc. was actually aware of this prior to the audit. It would have prevented penalties being charged, criminal charges, and it would also have reduced the interest. Importantly, keep personal and company tax affairs separate. In this case, the doctor and the Doctors Inc. They must all have a clear separation, their own financials, etc. Look very carefully at VAT obligations and where they lie, so that you don't end up with the understatement of output tax, and really understand the rules for the practice model. So through those lessons learned, I've listed for you in the slides very high level the actions that you can do, and it really all relates to those. And I'm not going to go through those now, but these are important, and you can have a look at those later. So I've gone a little bit over my time now. It's now 9:04. I'm going to turn the camera off and then have a look at whether or not there are any questions for me in the chat and whether or not I'm able to address those. So let's have a look. I'm not seeing any specific questions in the chat. So if I'm correct in that, I'm going to close off now and just say thank you very much, everyone, and I look forward to seeing you again. Oh, apologies. There does seem to be one question. Apologies. I wasn't in the Q&A. Apologies. So, how ethical is SARS, Willie? One would hope they should be ethical. They should be unbiased. They should be ethical. I will leave that that there. Kylie says, I have a customer who's not giving me the information I need to effectively calculate tax owing. Therefore, I'm unable to assist. I've told the client I need the information, but the income tax returns are due. The fact that they are not enabling me to do this, does it mean I'm complicit? You would be complicit if you are submitting the tax returns without the required information. And I think as a tax practitioner, you're taking a risk in terms of that. We know SARS is going to risk profile us. Yes, and you really need to evaluate, is this a client you actually want to work for? If they're not cooperating with you and giving you what you need, Kylie. And then Villy, again, SARS made it difficult to do systematic, due to systematic system problems experienced for taxpayer to be tax compliant. SARS create the problems and then penalize taxpayers. I don't disagree with you in terms of the system's challenges, Villy. And you also raise here that SARS enforces timelines on taxpayers but does not adhere to the timelines. I agree with that to some extent. But in practice, I do actually see SARS complying a lot, even though if it's just to request extension, as we had in this court case, they actually asked extension from the taxpayer to consider the validity of the objections, because they saw they were going to go out of the time period and they were trying to access the taxpayer system. So here, actually, SARS was adhering and very much the taxpayer was not. And they were actually quite lenient with the taxpayer, I think, in terms of eventually where we ended up. Okay, and now we've got a question from Nasik. Can SARS disallow expenditure incurred in the production of income when bank statements have been providing detailing the verification of expenses on the bank statement, but in absence of providing receipt of the expense or legible invoice or receipts? Now, as I said, mentioned in the slides, you are required to keep document evidence and the records. So if you're unable to prove those amounts by the supporting documentation, then I would say yes, they would be able to disallow those expenses. So retaining that documentation is very important. Here we've got a question from Nikki. Taxpayer received additional assessments in 2025 for 2020 with reduction of primary rebate. This is due to ceasing tax residencies. So I understand we should be doing two returns, one before ceasing and after ceasing. However, this was addressed back in 2020 when the taxpayer ceased tax residency. Now SARS has raised an additional assessment. We can't request reasons nor object on SARS e-filing. How do we sort this out? Any suggestions? Nikki, I'll give that some thought, and I'm going to ask you if you wouldn't mind popping that in an email to me, so that I can get back to you on that in terms of what possible remedies we could consider here that might be available to you. Okay, and then Nasik again, SARS disallows all expenses in the absence of some legible receipts and invoices. Again, I don't know the context of that, Nasik, and I think it would maybe then be based on the nature of the invoices. So, for example, a medical practice and there's invoices from Woolworths, significant amounts, and SARS could look at it. Yes, you've got the supporting documentation, but is this a legitimate business expense? So again, A, if you have no supporting documentation, you are already in trouble. B, the fact that you have supporting documentation does not necessarily mean that the amount is going to be tax deductible. You should be able to substantiate that it is in terms of that it is in the production of income. And if SARS then still disallows it, that then becomes a different matter in entirety. Okay, and then from Anonymous, is it useful visiting a SARS branch office to resolve issues? It can be, yes. I don't want to say no, but it is difficult. And we know that SARS is actually kind of discouraging taxpayers to walk into the branch office. You need to make an appointment, etc. And they really actually prefer things to be handled electronically and through those channels. And then also you've got everything recorded there, because I have experienced situations where taxpayers have gone into a SARS branch office, but everything is then not captured on e-filing, and the supporting evidence is provided to SARS, etc., manually, and somehow between the SARS branch office, it never quite makes it to e-filing, and the issue isn't then resolved. So I think it would depend on the issue that you're wanting to sort out. And I'll leave it at that, but where possible, rather try and use the appropriate SARS channels and query emails, etc., to handle that. Okay, and I think that's all their questions, everyone. So thank you for bearing with me. This is the first time I'm working on the system, so for missing the questions there. Really appreciate the attendance and hope you all have a good day. Thank you and goodbye.